Mortgage interest rates play a crucial role in determining the health and stability of the housing market. When interest rates are low, more people can afford to buy homes, which often leads to increased demand and a rise in home prices. On the other hand, when interest rates are high, borrowing becomes more expensive, making it harder for people to secure a mortgage and purchase a home. This can result in decreased demand for housing, lower home prices, and a slowdown in the market. When mortgage interest rates change, a slew of housing market experts surface and make bold claims on how the market will unfold. They cite as fact that rising rates mean cooling sales, while declining rates equate to rising sales. I've seen these claims for years, but I wonder if they're true. We are going to find out in this short video. Be prepared to be stunned with what we've uncovered. It's important to note that interest rates are influenced by a number of factors, including the state of the economy, inflation, and monetary policy. The Federal Reserve, for example, can adjust interest rates to help stabilize the economy during times of economic uncertainty. This means that interest rates can fluctuate rapidly, leading many to call for changes in demand in the housing market. Experts claim that mortgage interest rates significantly impact the housing market and can make or break it, depending on the current interest rate environment. Low interest rates can promote economic growth and stability, while high interest rates can lead to decreased demand for housing and a slowdown in the market. In order to provide the best guidance for home buyers and sellers, I've analyzed more than 30 years of mortgage interest rates and home sales. As with most housing metrics, the results were not what the experts led us to believe. If you're a longtime subscriber, then you know I often review the U.S. housing market to reinforce what we know about local housing market conditions. If you're not a subscriber, please click the thumbs up like button and subscribe now so that you get all my new content when it is fresh. If you really want to know what's going on in housing, to see and hear the data explained, to evaluate the facts and ignore the hype porn that is so prevalent online, then subscribe now and I'll keep you in the know. So here's the logic behind self-appointed experts' claims about the link between mortgage interest rates and annual home sales. You have to admit, they certainly make a lot of sense. They tell us that the impact of interest rates on the housing market can be seen in both the short term and long term. In the short term, a sudden increase in interest rates can lead to a decrease in demand for homes as prospective buyers struggle to secure financing. The lack of well-funded buyers can cause home prices to drop and result in a slowdown in the market. In the long term, high interest rates can impact the economy as a whole, leading to decreased consumer spending and a reduction in economic growth. On the other hand, when interest rates are low, more people are able to afford to buy homes, leading to increased demand and a rise in home prices. Low interest rates also make it easier for existing homeowners to refinance their mortgage, which can help them lower their monthly payments and free up extra cash for spending. This, in turn, can stimulate the economy and promote growth. Now, that's all well and good in theory, but let's look at what actually happened over the past 33 years. This graph plots the annual change in mortgage interest rates in blue and the annual percentage growth or decline of U.S. home sales in red. When we put it all together, we find that home sales only fell in 45% of the years that mortgage interest rates rose, and home sales rose in just 73% of the years that mortgage interest rates fell. These are hardly the numbers to confirm the belief that home sales go as mortgage interest rates change. Here's what 33 years of home sales and mortgage data reveal. The number of years where mortgage interest rates rose was 11, which is 33% of all years measured. The number of years where mortgage interest rates fell was 22, which is 67% of all years measured. The number of years where home sales rose was 22, which is 67% of all years measured. The general increase in the number of home sales makes sense. As the country grows, we should expect more home sales more often than we should expect fewer home sales. The number of years where home sales fell was 11, which is 33% of all years measured. So home sales fell in 1/3 of the years and mortgage interest rates rose in 1/3 of the years. Does this make the experts correct? Well, as Lee Corso would say on College Game Day, not so fast, my friend. The number of years where mortgage interest rates rose and home sales rose was 6, which is 55% of years that mortgage interest rates rose. So more than half the years that mortgage interest rates rose, the number of home sales rose too. The number of years where mortgage interest rates dropped and home sales fell was 6, which is 27% of the years with falling interest rates. So declining mortgage interest rates failed to spur home sales in more than 1/4 of the years where rates declined. Now here's the big one we've been waiting for. What happened in the past to home sales when mortgage interest rates moved higher? The number of years where mortgage interest rates rose and home sales fell was 5, which is 45% of the years when interest rates went up. That means the experts would be correct in fewer than 1/2 the years that rates rose because statistically they should be expecting home sales to rise. The one claim that seems to be shared universally by all YouTube real estate experts is that the number of home sales always rises when mortgage interest rates fall. Well, the number of years where mortgage interest rates fell and home sales rose was 16. That's 73% of the years when mortgage interest rates declined. Home sales fell in more than 1/4 of the years when interest rates fell, and home sales rose in more than 1/2 of the years when mortgage interest rates rose. There has to be more to changes in the housing market than just mortgage interest rates, right? The big takeaway from 33 years of home sales and mortgage data is that more variables are involved in forecasting home sales than just the change in mortgage interest rates. That's why we cover a broad range of real estate related topics and data sets on our channel, as we want to have the best information possible when it's time for your next real estate transaction. Will Biden's national rent control plan save rental affordability? You can hear my thoughts on Biden's plan by clicking on the box in the top left corner of your screen. Just click on the box below it to discover the top 7 home selling technologies in 2023. Please remember to like this video, check out the links below it, and subscribe to our channel so that you never miss anything.